Hi everyone, this is part 2 of a screencast for Independent Colleges Dublin, introducing capital gains tax under the ACCA P6 IRE Advanced Taxation syllabus. And for this screencast, we're using FA13 and indeed parts of the BPP text associated with that paper. So you may remember from part 1 we talked about the basics of CGT. Well, really, what are they? Well, essentially we're looking at 3 lines for a calculation. Proceeds less cost equals gain. Now each of those elements will be given in the question. So what we're required to do is really to strip out of the question the various items of proceeds and costs, deduct one from t'other, and then from that point take off any capital losses brought forward from the previous tax year. Okay, so we had a situation the previous tax year perhaps where the losses outweighed the gains on a series of different disposals. Once we have that, we deduct the annual exemption of 1270, and then we get capital gains on which we have to pay tax, and we pay tax at 33%. So there's a sort of a basic summary of screencast 1. In this first area of screencast 2, I'm going to talk about losses. Now, I mentioned these in the first screencast, and really what we're talking about here is a situation where the costs in the question outweigh the proceeds, and as a result of that we have a capital loss. Now, you remember that there's a different treatment between capital losses in our tax year and ones from the previous year. Really, in our tax year, we could have multiple disposals, 3, 4, 5, or 6. And what we're looking to do on the sort of page 2 that I outlined to you was to have those series of different disposals or different sort of 3-liners on that page, and really to total them up. So really on our page 2 of our workings, whether or not it's a report to a tax partner or a report to a client, really we're looking to have a series of disposals, a series of 3-liners coming up with a sort of a job lot figure, which may well be a gain. And in fact, it's likely to be, because John Morrison, your examiner, will want you to calculate some tax. So just try and remember that a capital loss in the year will be lumped into a set of transactions. There may be gains, there may be losses, so we're looking at the net effect of those. And we're bringing them up to our page 1 to give us our total gains, and from that we move forward as outlined earlier on. Now, it may well be that we have restrictions on the use of losses. Now, one of them that I mentioned to you in screencast 1 was just this idea of having a connected party. So in other words, I think in the example we had Michael and Mary. Michael is disposing of an asset to Mary, who's his sister. He's making a loss. So in that instance, that loss is restricted. In other words, that particular loss, we can't put that into our normal pot for the year, because it's a loss to a connected party. The only way that Michael in that situation, or indeed anyone else, can relieve a loss to what we call a connected party, like a sister, mother, brother, etc., is to offset it against a future gain to that same party. So watch out for John Morrison, your examiner, putting into a question some sort of transaction between connected parties, because that loss specifically will be restricted. Okay. Now, moving forward from here, indexation relief is something that I mentioned in the previous screencast. And really, indexation relief is just another cost, or indeed it's a way of uplifting certain costs to current value. So what the revenue allow us to do is to reflect many of the costs associated with the transaction at current value level. So in effect, we're allowing for inflation or real prices. Okay. Now, we must remember here that we can only use IR or indexation relief on assets acquired before 31st of the 12th of 2002, and you'll see that reflected in your tables. In effect, you'll only have indexation allowance figures or indexation relief numbers up to that date. Okay, so you won't be able to index after that, because you won't be able to come up with an indexation relief element. Okay, so in terms of the sort of the types of costs that we can uplift. Really, these are the ones. So really most of the costs, the original cost of acquisition, the incidental costs, for example, fees that you've incurred, auctioneers' fees, legal fees, and also enhancement costs. And you remember from Screencast 1, really an enhancement cost is just something that improves the asset. So we bought the asset and then we've sort of added to its value, perhaps an extension on a house, for example. So we can uplift each of these costs. And where we find the indexation figures, as I mentioned, is in the table, and I'll show you an example of that in a moment. Now, I've said there that this is some easy marks, and it very much is. And within P6, whether or not it's the UK or the IRE syllabus, what we've got to do is just make sure we get as many easy marks as we can, and perhaps some of the more difficult marks, but we don't need 100% to pass, we just need 50. So this area of indexation, although it may seem a little bit unusual, let's try and practice and get good at this, because this is just really applying a value to a given cost figure and including it in our three-liner. There's nothing complicated about it, okay? We have the tables available so we can check the numbers and hopefully get the right uplifting value. Okay, so moving on from here, just a sort of a cut and paste from your tables, you can see that you're given various sort of multiple factors, and you simply have to take the correct one. I draw your attention to the actual correct acquisition date, and you'll see that historically we were working to sort of 5th of April when the original tax year end in line with UK. So watch out for where you're taking your figure from. We'll have rather than 1st of January to 31st of December, we're actually working to 5th of April in each of these historical years. So in effect, you've got to look at what was the date of acquisition, the date that the item was purchased, and find the relevant tax year and take the multiple factor from that tax year. Okay, so just watch out for that. Again, in this sort of area, practice makes perfect, and there is some easy marks to be had. So let's just get a good fix on how we index up and what we can index up indeed. Okay, now in terms of how indexation works, apart from getting the right factor, really, there's a couple of little tricks that you really need to be familiar with. Nothing too complicated, but really these relate to a sort of a restriction on that uplift. In other words, obviously we'd like to uplift as far as we can, but there are certain rules that we need to adhere to. And the first one really is that, if we have a situation where there is a monetary loss, what we call a monetary loss, in other words, before indexation, there is already a loss on the transaction. So say, for example, the cost was 100,000 and the proceeds were 50. In effect, we already have a monetary loss of 50,000. Okay, so within our three-liner. So in that case, the IA or the Indexation Relief, as it's known in the Republic of Ireland, cannot increase that loss. So in effect, we can't actually use the indexation relief to make a bigger loss because there's already one there. Okay, that's the first rule. And the other thing that we can't do is really convert a monetary gain into a loss. And in terms of an example of that, really a situation whereby we've made a gain on an asset, and if we apply the indexation, we actually go negative. Yeah, we go negative. And what the rule says is you can bring that monetary gain down to zero, but you can't make it negative. So we can only use really the indexation relief up to the point that it brings the gain down to zero, but not any more. And what I mean by NGNL is no gain, no loss. So in effect, you have a situation where you had a monetary gain, you took proceeds from cost before any indexation relief was applied, you had a monetary gain. Now you're trying to add in the indexation relief, and that indexation relief is so big that if you take it as it stands, it would bring you into a loss-making position. You can't do that. You can only bring it down to zero. So in effect, you end up with no gain or no loss. In effect, you end up with zero. So just watch out for these two tricks, okay? Moving on from here, In terms of exempt bodies, really not a very, very important area for me anyway in this area of CGT, because what John Morrison will want to do is he want to make you do some calculations. If the body is exempt for CGT, then there won't be a calculation. So I just really draw your attention to the text and the sorts of bodies that are exempt, charities and portfolio, etc., and several others. But whether or not this would feature large in a question, I don't think so, because it doesn't make for much of a question. Okay, so a certain element of rote learning for you there. Okay, moving on from there, CGT withholding tax. This is quite unusual and but sort of straightforward in one sense. Really, what we're saying is that the revenue have a restriction in certain circumstances, i.e. on the sales of certain items, where it requires the purchaser, to withhold 15% of the proceeds. In other words, not 15% of the gain, 15% of the proceeds. So just watch out for that. And it's sort of aimed at really non-residents, people that are disposing of particular assets, perhaps land and buildings, where the proceeds are in excess of 500K. It's sort of aimed at people who are disposing of assets and perhaps aren't subject to ROI taxation. So again, certain amount of rote learning here, that 15% of proceeds, the proceeds have to be in excess of 500,000K for this to fit in, to trip in, as it were. Okay, and in terms of getting around it, let's say that we're in a position where this is the case. Well, how do you get around it? Well, there are a couple of ways that you can get around it and get around this deduction from proceeds that you're just about to receive, that the purchaser is required to deduct from you. Any one of you being, if you're resident in Ireland, if there isn't any CGT due, or if the CGT is already paid. So again, we've got to just rote learn this, as I say, mainly aimed at non-residents who are disposing of specified Irish assets, land and buildings, for example, or the goodwill of an ROI trade. Okay. So chap on the right here looks as if he's got his get out of jail card free element there. So he has managed to get around it because he's satisfied one of these conditions. Okay. So development land. Now, I draw your attention to this area not so much in just in capital gains tax, but really across the board in the P6 IRE syllabus. Where you see development land, I'd make a note to be clear on the tax mechanics. And the reason that I say that is that it just seems to me that that this is a very, very examinable area, and indeed it has been examined before. It's a little bit sort of complicated in parts, not so much just in CGT, but there is the syllabus where this is mentioned, for example, in the restriction on losses or trading losses associated with an individual who's dealing in development land. So that's more sort of an IT thing or income tax. So I would say watch out for land, development land. Where you see that in the P6 syllabus, focus in on it, because I think it's very, very examinable. So let me take you through this idea here within CGT. Really, in terms of a definition of development land for our purposes, really it's just land situated in the ROI, where really the proceeds are greater than the current use value. Yeah. Now, you may look at that and you think, well, what does that mean? Well, what we mean is that we have an asset that is land or defined as development land, which has been sold, but the value of the proceeds would appear to be more than the current use value of the land. Now, really what we mean by that is there's some element of an increment in the value that really is down to the fact that the value or the asset concern, the land concern, has some potential. Yeah, in other words, it has some potential over and above its sort of normal current use value. Okay. Now, the reason that this is important, and you'll see from the question that you'll be given a proceeds, but you'll also unusually be given some sort of current use value, and you must be thinking to yourself, well, why am I getting that information? Well, the reason that you're getting that information is because there's a slight twist on the way that we calculate our three-liner, where development land is the asset concerned. And the key thing really is that the indexation relief will not apply to the development value. Okay, now that may lose a little bit in translation, but when we look at a question, I think it'll become a little bit clearer. So the key thing is, well, firstly, is there development land? We'll be told that there is development land most likely, and even if we're not, we'll see that there's a proceeds that's higher than current use value. Okay, so what we're looking to do is say, well, okay, this is unusual. Can I remember that there's a restriction in some way on this three-liner? So what is the restriction? Well, the restriction really is that your costs are going to be kept down because you cannot you cannot index up the development value element. Okay, now I'll show you a question that will actually make that a little bit clearer. You'll see bottom right-hand corner there that I put a chap just watching you, and really I'm just trying to do that to draw your attention to the fact that that's your examiner. He's watching whether or not you're going to have a fix on this area, because I think it's very, very examinable. Okay, so do try and get a fix on it. So in terms of an example here, this is from BPP text 2012 rather than 2013, but the mechanics and the workings of tax are very much the same. So I'll just give you a moment to read that. Okay, so what you'll see within this question is that you're not actually told that it's development land as such, but you are unusually given some current use values which are different from the other values. So in other words, Henry sold land for 200,000 when the current use value it was 20,000. Slightly unusual when you think about it. Why would he be selling at an increased value? Well, the reason that he's selling it is at an increased value is that this is development land. There's something that is worth something that he's selling, and what the revenue are doing is say, okay, well, we're going to tax you, but what we're going to do is we're going to restrict your costs. We're going to restrict your costs because there's some development value element in here. They don't like the idea of uplifting all of the costs. So what we'll also see, aside from the increased proceeds as a result of there being a development value element within the transaction, is that when Henry originally purchased the asset, the land concerned, again there was a difference between the current use value of 10, yeah, and the value, the increased value of 40,000. Okay, now he purchased at £40,000, 40,000 euro indeed. The current use value was 10, and he also incurred some costs. Now, what the rule in relation to development value says is, as far as the revenue are concerned, yes, you can have some of those costs deducted in your three-liner, that's fine. But as far as we're concerned, anything associated with that differential, that differential between current use value and that increased development value, then we're not going to allow you to apply your indexation relief to it. Now, if you remember, all that indexation relief does is simply uplift the value to the current level. In other words, at the date of disposal. And really, what we have to do is we have to look at the costs, really split them between current use and development value element, and really only apply the indexation relief to the current use value. Now you'll see how we do that in the on the next page. Okay, so let's look at the answer to this. As you can see, in terms of the proceeds are just the proceeds. In other words, there's nothing sort of unusual that we need to do with that, albeit for the fact that the question writer in this case mentioned that there was a current use value that was different from the proceeds. That doesn't affect our computation. In other words, it doesn't affect our three-liner, because if the proceeds are 200,000, as far as the revenue is concerned, that's the proceeds that you're going to use. We don't mess around with that area. That doesn't impact upon our indexation relief restriction. But here's what does. And if you look at these areas here, it looks a little bit unusual because we're not just simply taking, our full cost of purchase, which was 40, and also our incidental costs of 4. What we're doing is we're splitting them into 2 areas. Yeah. Well, in effect, we're saying that the element of cost that's relevant for indexation are these 2. Okay. And in effect, where we get those numbers from is really that if we look at the current use value at purchase compared with the actual purchase price, which was the increased value, what we'll see is we have a fraction of 1/4. Okay. So what the revenues say is, well, it's fine for you to go back to the purchase date and take the current use cost or the current use value as cost at that date and index that up. But the element that relates to the development value, i.e. the difference between the 40 and the 10, i.e. 30, can be indexed up, but only at 1. So in effect, you're not indexing it up at all. Now, unusually, they do the same thing with the costs. So you remember that there was a cost associated with the acquisition of 4,000 euros. So what the revenue are also saying is, well, as far as they're concerned, because this asset is development land, as far as they're concerned, only a proportion of those costs can be indexed up. They're all allowable, but only a proportion can be indexed up. So you can see this how this area is a sort of a dream for tax examiners, in the sense that they have the chance to really sort of try to confuse you. Okay, so all that we need to remember is that where we see a disposal where the proceeds are greater than the current use value, and or the costs, the original cost is greater than the current use value at the time of acquisition, that we need to remember that indexation relief won't apply to everything as it does normally. Okay, so a little bit tricky, so just work the questions and I think it will come to you. Okay, moving on from here. Really, this is just a manifestation of the question in its entirety for your benefit. So when you're playing this video, hopefully it will help you to have the question and the answer on the one page. Okay, so in terms of losses, one little area here, not too complicated. Really, all that we're saying is that, aside from this issue of the indexation relief being slightly messy, we're saying that if you have a situation where you have an asset that is defined as development land, then what you need to do is you need to be careful about how you utilize losses associated with disposals of that development land. Okay, and all that you do is you simply say that if you have a development land loss, you can certainly put that into your normal pot. In other words, you can use that loss against any gain. So you remember going back to screencast 1, I talked about this idea of having a current year pot. And I said that we could have 4 or 5 or even 6 different gains and losses. Well, I'm fine to just put my development land loss into that pot. There's no restrictions on that or using that loss against other gains, okay? But the only trick here is point number 2, is that where the reverse is the case, in other words, where we have other losses, we can't utilize other losses on the sales of other chargeable assets against development land gains. Okay, so it sort of works in reverse. So again, in terms of learning this area, you may find this area slightly confusing. In terms of learning it, let's just work through the questions in detail and slowly. Certainly from my experience with dealing with P6 students, that review of the answer, once you've done it, preferably under timed exam conditions, that review is where the learning takes place. And this would be a classic area that, on reading the text, once, twice, even 3 times, you may think, well, I just don't understand this. But work the questions. That's how you'll get an understanding. Okay? And remember that when you're doing P6 questions, really what you're looking to do is to get more than 50% in each of the answers. We're not looking for perfection. So as long as we can make a reasonable stab at questions, let's say in this area of development land, let's try and remember that the IR, the indexation relief, is not going to be applied to the development land element, either of the original cost or indeed of any costs associated with the acquisition. Then in that case, we have a fairly good chance of getting more than 50% of the answer. As I've said below there, practice is the key to this area, and certainly many areas of the CGT syllabus. Okay, so moving on from here in terms of further detail, and as we're heading towards the close, exemptions and relief. Touch on one or two of these. Really, the annual exemption I've already talked about. I've said that the annual exemption is just a free pay amount that we deduct from net gains just before we're about to apply our 33%. Okay, watch out for the fact that we can't transfer an annual exemption between a married couple or a set of civil partners. It's really use it or lose it. Each individual has their own exemption. There are some planning points which are relevant here, but I won't go into the detail of them on this particular screencast. For the sake of basic level of CGT, let's just try and remember to deduct that annual exemption. I've certainly found in the past, in this the pressure of the day of the exam, and even students who do really well say to me that they sometimes make the mistake of not deducting the annual exemption. So try and make a point of doing that when you're doing your CGT comps, so just making sure that you get that easy mark. We might get a mark just for doing that, just for deducting 1270. Okay. Do remember, of course, that I said that we're going to use capital losses before we deduct the annual exemption, i.e. losses brought forward from the previous year, not the other way around. Okay. Now, in terms of married couples, touched on it earlier on, and this idea of, each individual person, whether or not they're married or not, has their own exemption, and that exemption is tied to them. Okay, so here we have a situation where, if they can't transfer their AE, why are they so happy? Well, that could be a number of reasons, but the particular reason that's relevant to this screencast is that for married persons, transfers between the two, in other words, disposals of assets between two, a married couple or indeed civil partners, are subject to what we call the no gain, no loss rule. So in other words, no gain or loss arises. So, how would you do that in practical terms? Well, what you would do simply is you would say that the cost equals the proceeds. In other words, how do you come up with no gain, no loss? Well, really what you do is you make, regardless of the transaction, the actual transaction that's taken place, it may well be that a husband and wife have transferred funds between each other in relation to the disposal of an asset. But as for our purposes, what we need to do is we need to assume that the sale proceeds is the cost. So let's just say that we have a husband transferring an asset that cost him 50,000 euros. If we were to do a three-liner, which we don't actually need to, but if we were to do one and represent it on paper, we would have proceeds equals 50, cost equals 50. The balance is 0, so no gain, no loss. Now, this does give us some CGT planning opportunities if you think about it, because what they could do is avail of this rule to possibly transfer some assets to each other on a no gain, no loss basis, and perhaps ensure that the second person avails of the gain. Maybe they have other transactions, CGT transactions on which CGT is going to be payable, and they want to utilize perhaps the 1270 of the second person. Perhaps they don't have any chargeable assets at all. So we could use this rule to mitigate their overall tax situation by, in the knowledge that any transfers between the two parties are not going to attract any CGT. So it's a way of transferring an asset from one to the other without any hassle at all to crystallize a gain with someone else. Okay. Now, question down the end there, the base cost for future disposals. So what I've said is, a husband perhaps transfers an asset to a wife, no tax implications. What's the wife's base cost? Well, the wife inherits his base cost. So his original cost becomes her cost should she sell at some point in the future. Okay. So moving on from here, really, in terms of a recap on this area, really, I think that there's certainly within CGT, like a lot of other areas, a lot of tricks. Okay, I think the main tricks are going to center around perhaps the more complex areas like CGT release. But in terms of what we covered in the intro so far, there are a couple of tricks. I'd draw your attention to losses. I'd also draw your attention to development land and how the development land sort of interacts with other assets. You remember that development land losses can be offset against any gains, but not the reverse. Okay, so in terms of other areas, I would say just be familiar with the mechanics of a basic CGT computation and try and work as many questions as possible. These two screencasts that I've done have been very much a sort of a basic level introduction to capital gains tax. It can get a lot more complicated, in particular in the area of CGT reliefs and indeed perhaps share transactions. Okay, so I hope these two have been helpful. Feel free to email me if you need any further help, and good luck with your exams going forward.